My take. Should you buy US stocks after a Moody's downgrade? A Moody's downgrade of US sovereign debt, typically reflecting concerns around fiscal stability, debt levels, or political dysfunction, can understandably raise investor anxiety. However, history suggests that such downgrades, while headline grabbing, do not necessarily imply long term doom for equities. Instead, they often create short term volatility and potential buying opportunities for long term investors. Why would you do this? There are five considerations. One, market reaction tends to be short lived. Following the 2011 S&P downgrade of US debt, equity markets initially fell sharply. However, the S&P 500 rebounded within months and continued its long-term upward trend. Investors may panic initially, but the US remains one of the world's most resilient and dynamic economies. Two, fundamentals still matter. Stock performance is ultimately tied to corporate earnings, consumer demand, and innovation. Most US companies operate globally with strong cash flows and balance sheets. For instance, a Moody's downgrade doesn't change Apple's cash flow, Nvidia's AI roadmap, or Microsoft's enterprise dominance. Three, safe haven status remains intact. Ironically, downgrades of US debt can lead to higher demand for US treasuries in times of global uncertainty. A paradox. This reflects continued faith in the US dollar and the overall economic system, which indirectly supports equity valuations. Number four, valuations and entry point. If stocks decline following the downgrade, investors may be able to accumulate high quality names at attractive valuations. Sectors such as technology, healthcare, and consumer staples often show resilience and long term growth potentials. And the fifth key element, risk management, is key. While a downgrade alone is not a reason to exit the market, it underscores the importance of diversification. A balanced portfolio across equities, bonds, and alternative assets remains prudent. So, in conclusion, buy selectively and stay focused on the long term. Rather than avoiding the market, investors should assess this moment as a potential buying opportunity, especially for fundamentally sound companies trading at a discount. Patience, discipline, and a long term perspective are critical when navigating headline driven volatility. That's the wrap for today, my dear viewers. And if you got value from this, please do subscribe, like, and share this video as much as possible. I'll see you again tomorrow morning. In the meantime, happy investing, stay inspired, and remember, it is all about money.